Your insurance check just landed and you are already planning how to spend every single dollar of it. Hold that thought for 1 second because the tax rules here are weirder than you would expect. Here is the wild part that surprises almost everybody. Money you get from a physical injury settlement is usually not taxed at all by the federal government. That rule comes from a piece of the tax code that treats your settlement like a refund for pain, not income for work. Think of it less like a paycheck and more like getting your broken phone replaced. You are just being made whole again. Now structured settlements take that tax-free idea and stretch it out over time instead of giving you one giant lump sum. Instead of one payment of, say, $500,000, you might get smaller payments every year for the next 20 years. The beautiful part is that every single one of those future payments usually keeps that same tax-free status. The growth inside the structure, the interest that builds up while you wait, stays untouched by the IRS too. Compare that to if you took the lump sum yourself and invested it in a regular account. Any interest or gains you earn there would absolutely get taxed like normal investment income. So in a weird twist, the slow and steady option can actually outperform the lump sum after taxes. It is like the tortoise beating the hare, except the hare also has to pay a toll booth fee the tortoise skips entirely. But here is where people mess it up constantly, and it costs them. The tax-free treatment only applies to the physical injury portion of your case. If your settlement includes money for lost wages or punitive damages, that slice often gets taxed like regular income. It is not one big tax-free bucket, it is more like a pizza, where only some slices are free and others still have a price tag. Another myth floating around is that selling your structured settlement payments later keeps the same tax perks. Once you sell those future payments to a factoring company for quick cash, the tax treatment can get murky and you usually lose value in the deal. People also assume interest earned before the settlement is finalized counts as tax-free too. It usually does not, so that waiting period interest can sneak up on you at tax time if nobody warned you. This is exactly why good accident injury lawyers structure the settlement language carefully from day one. They separate the categories clearly so the IRS cannot argue later that your pain and suffering money was secretly disguised wage replacement. Insurance companies are not exactly rushing to explain any of this to you either. They want the case closed, not a tax seminar, so the burden of understanding this often falls on you and your attorney. The lesson here is not that taxes are scary, it is that timing and structure quietly decide how much money you actually keep. A smart settlement is not just about the number you agree to, it is about what survives contact with April. If any of this sounds like something you are dealing with right now, we would love to help you sort through it. Do you want to learn more about our company? Check out our links in the description.